Hello, and welcome back. Lots of things happening in the markets these days, so I'll have to be making a few videos. Now, in this one, we're going to be examining cannabis stocks, and in this specific video, it's going to be Tilray brands. As you'll see, yesterday we had a big jump over here. October 6th, the price of the stock went almost double, as you'll see over here, a little bit less, of course. But still, it's down 75% for the year, and today it's down 10% with the rest of the stock market, again going down after we got the jobs report, and we have less unemployment than expected. And as you can understand, this pushes inflation and continues this kind of inflationary environment that the government has set up. Now, let's take a look at what has been happening in regards to the news around cannabis stocks. So why are they heading higher? As you'll see here, first of all, Tilray Brands reports Q1 loss misses revenue estimates. And this is one of the reasons why the stock is actually way down today. Came out with a quarterly loss of 8 cents per share versus 6 cents per share that were expected, as you'll see here. Now, the company is losing tons of money, as you'll see. And the surprise is super negative over here. Again, it's a company that still hasn't found its mojo, I should say, and still keeps losing money. I guess you could say that it's growing. But as you'll see, they have posted revenues of 153 million over here for the quarter, and it is up by missing the Zacks consensus estimate by 1.5%. This compares to a year ago revenues of 168 million, so it's actually a little bit less. Now, what happened with cannabis stocks here? Why were they up? That is yesterday, pretty much. So they rose after President Biden announced federal pardons for possession of cannabis, pretty much. And so the legal market continues to grow, and the stocks still sell for a fraction of their 2018 peak, when remember there was this hype for this cannabis, all the cannabis stocks pretty much, when Canada moved towards legalization. And as you'll see, they all rose at least 20%. Some of them actually even more. And they are down quite significantly since its 1 year high. As you'll see, Tilray at its height sold for nearly $150 per share, and Canopy Growth for nearly $50 per share. And so as you'll go back here, you'll see that we are sitting at 3 right now. So this is way less than what the company has sold for at some point. So way less, insanely less actually. But if we take a look at the metrics here, you will see that the P/E ratio right now is getting to positive territory in the latest quarters, yet still the price to free cash flow is negative, and the company is also printing an absurd amount of stock. Again, to be expected, as the stock price of this company was actually higher. They want to be funding themselves. That's the board. And one of the good ways to do that is actually by issuing more shares. And this is what they did here. Now, as it's going down, we do expect this to subside, of course. We don't expect them to keep issuing shares. And that's exactly what has been happening lately, as you'll see. They mainly took advantage when the prices were at this level, which, again, makes a ton of sense. Now, the revenue of the company has been growing, again, not tremendously, but the net income has been going down along with the free cash flow here. And it's only the total equity that always goes up with these companies because they're issuing stock, and that's how they fund themselves. They're actually getting money from investors willing to get all this dilution going on for themselves. And in terms of margins, again, they're negative because the company is losing money. And yeah, there's not much else to see here. Not much debt because the company doesn't didn't really have to get much debt since they fund themselves through equity, through issuing stock. And you will see that the revenue has been growing quite some, at least till 2018, but then kind of stalling a little bit in the past couple of years. And you would expect with that with this with the COVID thing that we would be getting some more people actually getting into cannabis, I would assume. Now, net income here has been going down, as you'll see, and this is always a bad sign to see, pretty much. And in terms of the balance sheet, it's going to be a story of the additional paid-in capital, pretty much, where the company actually took advantage of the prices of the stock, pretty much issuing more and more. And the total equity keeps on going higher over here, again because of the additional paid-in capital, because of the company issuing stock here, issuing shares. And they have about 1 billion in total liabilities. In terms of the free cash flow and the cash flow, pretty much, you will see that the operating cash flow is in negative territory, even after the adjustments here for stock-based compensation, depreciation, amortization, and all the other items here. They are still in negative territory here, starting from a negative net income over here. In terms of investing activities, just investing a little bit here. And in terms of financing, getting some extra debt, slowly getting some extra debt, it looks like over here. So after actually issuing common stock, they seem to be getting some debt as well. So yeah, we're getting at a company where it starts to be getting a little bit of debt here after issuing tons of shares. Now the free cash flow is also sitting at negative territory here, as we'll see. Pretty much getting more and more negative, at least significantly more negative than last year, that is. And if we take a look at our stock evaluation too, it is going to be a problem, because what do you do here? Now the revenue growth of the company has been all over the place, as you'll see, though lately growing less. And so we will go with, let's just say 10, 15 and 20 for this one and see what's going to happen. In terms of the net income margins of the company, again, all over the place here, really all over the place. So what can you do? There's not much to do here. The company has been having too many negative years, so they are basically losing money. We're going to go with marginal profitability and see what gives 1, 3, and 5. And in terms of free cash flow margins, again, we cannot really rely on historical data, because the company hasn't been making free cash flow pretty much. And so we're going to go with something that is rather typical for companies like 80, 90, and 100. That's something that we typically do when we're getting these kinds of companies where they are not really profitable here, going with very low profitability, like marginal profitability, and then free cash flow that's very close to this marginal profitability pretty much. And an annual return of 13%, what we typically want to be making at least for our investment in a single stock, in a single company. And you will see that even with these kinds of metrics, these kinds of projections, this is still a relatively expensive stock. And the current price sitting at 3.4 is still high from from our highest estimates, even from our estimates of growing 20% and with a net income margin of 5%, which is nowhere near happening. Has happened only once, I believe. Net income, actually, this net income margin was very nice here, but at a much lower revenue here, which means lower costs, means a lot of different things, and so the company hasn't been following through. So yeah, at this price, it's gonna be tough to make a case for buying this one, and especially after it went down after the announcement. It's a play that is sort of like a lottery ticket. It's a trade for the most part, and not really a company to hold for the long term. Really, it's expensive and it's not doing that great right now. But it's definitely worth examining, and definitely worth examining the whole space right now, as it's getting some pardons from the U.S. government here. It may be worthwhile at least having it in your wish list, and taking a little bit of a closer look at these companies as they go through their quarters, see whether we can get a better price. Now, if that goes down a lot, maybe there's something to be said about buying near $1 or so, maybe. Just if you want to be a little bit risky here and have some potentially nice rewards for extra risk. But there is risk with this one, no doubt. Even if you buy near $1, there is definitely some risk here. And the fact that the company hasn't been making money and also issuing tons of shares is something that I hate to see. Apart from the fact that they are slowly beginning to be getting some debt, even though they don't have much debt now, it looks as if they are kind of heading towards that space. After having printed a ton of shares, it doesn't really make too much sense to actually be issuing more shares at this price. It doesn't make a ton of sense. So at some point, it actually makes more sense to get debt instead of issuing shares. It would make a ton of sense to issue shares here, which is what they did. But when the price of the stock is that low, I mean, it doesn't really make sense to dilute shareholders that much for so little gain compared to what it was near $100 or 150, which was an insane increase over here. And that would make a ton of sense for pretty much raising some capital for the company. So this is why you should be super careful about these companies. Buying this one is super risky, obviously, and it may, if we enter back in an era of irrational exuberance, pretty much, maybe you will get to a decent level and make some money out of this one. It could even be a multi-bagger if we enter this kind of normal environment where everything goes up, or it has been happening for the previous years. But right now it doesn't look like that's the case, at least for a little while. So these kinds of companies could even go out of business potentially. So especially if this kind of environment continues for a while, they're not making money, so super dangerous here. I would be cautious and maybe re-examine once the market reverses and once a lot of companies begin to kind of make more money and raise their stock prices. Maybe only then it may actually make a little bit more sense to pay even $5 and get the company as it's getting to profitability, frankly. And we will be around to be examining these cases. Now, thank you for watching the video. Remember to leave a like and subscribe if you are new around and you haven't subscribed already. And I'll see you in the very next video. There's going to be quite a few today, I believe, because there's a lot of things happening in the markets, and I'll see you soon. Bye bye for now.